Welcome to The Two-Handed Economist with John Diamond, where we look at issues from all the angles. President Truman once asked for a one-handed economist because he wanted someone to help make decisions and to not always say on the other hand. In this podcast, we try to look at every issue from multiple angles in order to reach the best solution to the problems at hand. Today, we're going to examine the structure of the corporate income tax and discuss why it's currently in flux with the upcoming expiration of the Tax Cut and Jobs Act. We're going to look at how to reform the corporate tax and the tax treatment of international income, as well as how should our tax treatment affect investment? Should we subsidize it? Should we treat it in a neutral manner? What about different types of investments? Investments that earn a normal rate of return, such as a dry cleaner, versus investments that may earn outsized returns, what economists would call economic rents, such as some newly patented drug or some new software component that doesn't face the day-to-day competition from the market or is protected from the day-to-day competition of the market. First, let's think about some big issues coming up in front of us. And I think the biggest on the fiscal policy front is the extension of the Tax Cut and Jobs Act that was passed in 2017. Let's break that into two pieces because the whole bill is massive. And we can think about TCJA as a corporate tax cut and as an individual tax cut. And so we're going to look today at the corporate side, the corporate and the taxation of international income. And we can talk a little about how we can accomplish some reshoring of American businesses just by tweaking the treatment of international income. So back in 2017, Congress passed the Tax Cut and Jobs Act. This was Trump's signature tax policy move in his first administration. It included overhauling the corporate tax code, slashing the corporate rate, and rewriting the rules on international income. But nearly a decade later, the corporate and individual tax systems are in flux again because when they passed the law, they made it a 10-year law, so it sunsets after 10 years. Congress and the president are left with a choice: let tax rates go up substantially or extend some portions or all of the tax cuts. So today on The Two-Handed Economist, we're just going to break down the corporate tax changes under the TCJA. And we're going to propose a path forward to improve the taxation of corporate and international income. So the TCJA on the corporate side reduced the corporate tax rate from 35% to 21%. And it moved toward a partial territorial system. So previously we were trying to tax corporate and international income on a worldwide basis. So we were going to tax every U.S. company both on their income in the U.S. and on their income abroad. TCJA went more to a territorial system where you only tax U.S. companies on their income in the United States, and then you have some mechanism to try to keep them from shifting income abroad. And there were several mechanisms in TCJA to do that, and they went by great acronyms like GILTI, FDII, and BEAT. And we'll discuss those in a little bit. But these provisions were basically some base broadening changes aimed at reducing the amount of corporate inversions, so corporations moving their headquarters from the U.S. to abroad, and to reduce income shifting. So when a corporation shifts income to a low tax country and in return shifts expenses to a high tax country in order to minimize the taxes that they pay. So we want to look at some of these and try to figure out, can we tweak them and how do they need to be tweaked moving forward? So another provision of TCJA was it included a provision that limited interest deductibility. And that's important because we're going to talk about expensing. And if you expense all investment, you really shouldn't allow full interest deductibility or any interest deductibility. Let's discuss the taxation of so-called global intangible low-tax income, or GILTI. More broadly, the treatment of international income by the U.S. corporate income tax. So TCJA attempted to deal with the problem of income shifting by creating a separate minimum tax on so-called global intangible low-taxed income. or the acronym GILTI. However, numerous analyses reviewed by economists, such as one of the best is by Dharmapala in 2024, we'll post that in the show note, suggest that the GILTI provisions have largely been ineffective, as income shifting has not decreased any more than we would expect given the reduction in the corporate tax rate from 35% to 21%. Although there are a lot of changes to the current international tax system that we could consider, let's just focus on a few that would increase the effectiveness of GILTI in reducing income shifting by multinational corporations. So U.S. firms that have operations both here in the U.S. and abroad. So one way we could do that is we could impose GILTI on a country-by-country basis rather than how it's now imposed, which is on an aggregate basis. So if we impose GILTI on a country-by-country basis, this would prevent taxes on income earned in high-tax countries from being used to offset tax liability on income shifted to low-tax countries, including tax havens. And so that should result in a reduction in income shifting, as there's just not as many possibilities to shift in country between countries and reduce your tax bill if you're restricted to a country-by-country basis, as opposed to now the system where it's on an overall or an aggregate basis, which gives you more opportunities to shift income between countries. In addition, we should focus on closing what's called the round-tripping loophole that allows companies to exploit the 10.5% GILTI tax rate while selling to American consumers by offshoring manufacturing to tax havens. So this loophole costs the U.S. Treasury about an estimated $70 billion over a decade and can be fixed with a relatively simple adjustment. Restrict the 10.5% GILTI tax rate for U.S. multinationals to profits that they earn from foreign sales. Any profits related to sales back to the U.S. market, which would be round tripping, so you set up an operation overseas to produce a good, and instead of selling the output overseas, you sell it back to American consumers. That would be restricted from getting the 10.5% rate, which we offer to foreign sales, and instead would be taxed at the 21% rate as paid by all other domestic companies. So this policy would increase fairness of the tax system because it would treat any U.S. firm selling back to the U.S. in the same manner. Currently, the GILTI provision is meant to give firms an incentive to produce in the U.S. So you still have this tax on sales abroad, but we don't want to give domestic corporations this incentive to just locate abroad and sell back to the U.S. And so we should just restrict it to foreign sales and not allow what has been termed round tripping. That would also raise $70 billion or roughly around that amount, and it could be used to pay for some of the cost. These provisions would create a roughly neutral business tax system, at least in the treatment of corporations, that eliminates the tax on marginal investments. And finally, let's discuss how we treat investment under the corporate income tax. Investment leads to economic growth and more labor productivity, which raises the standards of living for everyone. So this is definitely a tax policy that we want to get right. Let's dive into those details. Taxing above normal returns, or economic rents, at the statutory corporate income tax rate. The way you do that is by exempting investment expenditures immediately. And if you exempt investment expenditures immediately, then you're effectively eliminating the tax on the normal rate of return. So you could think of that when economists talk about normal rates of return, we're talking about what you could earn in the market, say on an investment that in a competitive market where you don't have any economic power, whereas an economic rent would be something you earn, say like a company that creates some new good and they have a patent on that good. The U.S. actually allows them to have a patent. They have the right to sell it for some period of time. And during that period, because they're the only one producing it, they have pricing power and they can earn above normal returns. We don't want to tax the normal returns. So what you can make on a product in a competitive market that has its returns competed away. But we do want to tax goods that earn economic rents, or at least we want to tax the rent on those goods. Such a tax system would not discourage investment at the margin, but it would raise revenue by taxing inframarginal or above normal returns. A standard economic result is that such a tax system is achieved with expensing coupled with the complete elimination of interest deductions. Under the current tax system, interest deductions are limited to some extent, but not eliminated. So some investments may actually face a negative tax rate, i.e. they would be subsidized slightly. The provisions allowing for expensing or immediate deductibility of purchases of equipment that were enacted under the Tax Cut and Jobs Act of 2017 are currently being phased out and will fully expire by the end of 2026. At that point, purchases of equipment, like purchases of business structures, will be depreciated under what's called the Modified Accelerated Cost Recovery System. It's often referred to as MACRS. Similarly, although throughout history they've been allowed full expensing since the early 1980s, research and development expenditures are currently amortized over a 5-year period. These changes were implemented under the 2017 Act, and in my view, we need to fix this part of the code. In order to incentivize investment, we need to allow immediate expensing of both investment expenditures and research and development expenditures. And we should disallow deductions for interest expense with such purchases. Note that in principle, we can also apply expensing for business structures. However, such treatment would be costly and it creates some potential for significant tax evasion. And so for that reason, it's generally not been implemented and it was not included under TCJA. I think we should continue that treatment. And instead, what you can do with investment in structures is you can continue to allow them to be depreciated under a MACRS type system, and you can allow them to deduct interest expense so that the interest on loans directly tied to investment in structures is fully deductible. This would result in a marginal effective tax rate on structures of roughly zero. In addition to the deductions for depreciation on structures and to the deduction on interest expense, we should think about accelerating the deduction for depreciation slightly to offset the effects of inflation at roughly a 2% level, which is the Fed's target for inflation in the economy. In addition to offsetting inflation, any accelerated depreciation deductions would also partially offset the taxation of equity finance investment in structures, which would be appropriate in this case. The net result would be a tax system that would be quite favorable to investment at the margin, an overall marginal effective tax rate roughly approaching zero, especially to the extent that the investment in structures is heavily debt financed, while we would continue to tax economic rents earned by such investments at the statutory corporate income tax rate. That's a pretty favorable tax system. You incentivize investment, but you still earn revenues from investments that are making above normal returns or capturing economic rents. Many additional reforms could be part of an overhaul of the corporate income tax system. But I think these two or three are the most important to think about in the next few months as Congress works on extending TCJA. In the future, we may want to think more boldly. We should consider reforms that would move away from the income tax structure and towards a more fundamental approach of taxing consumption instead of income, such as moving to a destination-based business cash flow tax. But we'll save that issue for a future episode. Okay, so we covered a lot today, and some of it's kind of complex, but here's what I want you to take away. First, the treatment of international income is important, and it can impact whether U.S. companies produce here or abroad. And so we need to get the details of that correct. Second, how the U.S. treats investment is important, and that will impact us for generations to come. If we want to continue to grow and prosper, it's important that we have a tax system that incentivizes investment in research, development, and new ways of making things that make us all better off. Lastly, we have to raise revenue to pay for the government. We can't continue to run deficits all the time. So when we have a chance to generate revenue with little economic distortions, such as taxing economic rents, it's smart to do so. The Two-Handed Economist is produced by the Baker Institute for Public Policy at Rice University in Houston, Texas. Production support was provided by Karina Zamel, Shannon Moriarty, and Kevin Young. Be sure to visit us at bakerinstitute.org for more, and thank you for listening.